want to look at Blackboard if you want, after the class, not now, but you might want to check to see if the results are on. If not, let me know. Myself, I'm more concerned about the distribution, of course. I just want to make sure that we get same results as last year, 80% with either 18 out of 20 or 20 out of 20, okay? So if you've done well at the midterm, you're well on your way to pass this class, regardless of whether you decide to invest as much time as you should for understanding topic 3. Because remember that the first part of the final exam, you're going to get general questions to answer. So if you got a 20 at the midterm, you do well with the first 3 questions. I mean, I don't want to encourage anybody to skip topic 3, but you could afford a 0 in the second part of the exam if your goal is just to pass, okay? But clearly, if you want a higher grade, you're going to have to deal with this topic 3. This is really the more challenging part of the class, so do take your time. I sent an announcement last week, and I asked you to review some of the results in the mathematical appendix. If you haven't done so, it's not too much of a problem for today because I'm going to go through the intuition of the results, but next week you have the tutorials starting. So the timing is really right for the tutorials because we're going to explain the solution. I'm going to give you the feel for how or why we're doing what we are doing, but then it's going to be up to you to get into the mechanics, okay? And I strongly encourage you to work hard on the fixed exchange rate case, because if you understand what's going on in the fixed exchange rate case, then the next part, which is flexible exchange rates, is essentially the same thing, okay? You just take your equilibrium conditions, you differentiate, write the equations in a particular form, and then solve them using a particular rule, which is Cramer's rule. So I understand that I learned Cramer's rule in high school myself. Apparently, it's not the case anymore. So if you have difficulty with that part, please review the document, the appendix. There are also a couple of videos that I posted on Blackboard. The rest, differentiation, partial derivatives, these are things that you saw in first year economics. So if you're behind in that area, there's not much, the tutorials are not going to help. You're going to have to study before you go to the tutorials, otherwise you're going to be wasting your time. So the model itself, again, I can't emphasize how important it is to have a model that allows you to understand what's going on in terms of monetary policy, what central banks are doing now to fight inflation. If you're using an ISLM model, there are a number of assumptions that are not, that make the model completely irrelevant for the discussion. One is the assumption of fixed prices. Well, if prices are fixed, how are you going to understand inflation then? Okay? So that's the first problem with ISLM. Second problem, it doesn't account for financial intermediation. Well, banks play a key role in the economy and represent an essential part of the transmission mechanism of monetary policy. So if you don't have banks, there are a lot of things that you're not going to be able to understand about, let's say, if you look at the Bank of England's latest monetary policy report, they talk about the impact of changes in interest rates on the banking system and eventually in the economy. So if you don't have banks, how can you understand what they are trying to do? That's number two. Number three, the way monetary policy is defined in the ISLM model or ISLM BP is not the way central banks operate, okay? I like to keep using that word. Everything you've been told about monetary policy so far is a lie. Central banks do not operate by controlling the money supply. They control interest rates, okay? So if you don't have a model that takes that into account, you can understand what central banks have been doing for the past couple of years. So these are the three main limitations. I expanded on that in the note that I posted on Piazza. So please read it. Just to give you an idea, actually, of how relevant this model is, just yesterday, actually, the Bank for International Settlements, which is an international institution based in Basel, at the center of the international financial system. This is the institution that provides guidelines to regulators, banking sector regulators. They have a set of common regulations currently called Basel III You'll hear more about that in topic 4, okay, when we talk about the globalization of banking. But this is a very important institution. I've been collaborating with them for several years now. And just yesterday, they published this book of mine, which focuses on macro analysis, using in one of the chapters essentially a more complex version of the model that we are seeing here in class, okay? So this is material that is being used in central banks, in international financial institutions, because they understand, of course, the importance of using models that are not and completely disconnected from what central banks do. So let me start by just summarizing what we've done last time. We started by the key features and assumptions of the model. One is the importance of banks. I just mentioned that. Banks play a critical role in financial intermediation, essentially intermediating savings by households and borrowing by firms, if you want. And one key aspect of banking is the existence of financial frictions. Financial frictions means essentially that the price mechanism does not operate as in a standard market where supply and demand are equilibrated, if you want. So these frictions can take several forms. A lot of them are related to asymmetric information, and this is due to the fact that though the borrowers know more about the characteristics of the projects for which they seek financing than the lenders, okay? So that creates a series of problems for lenders. How do you verify the state of nature when a borrower claims to default, essentially? Okay, that translates into costs, and typically banks are going to charge a premium to risky borrowers above and beyond the marginal cost of borrowing, simply to reflect the riskiness of the project to which they are financing. Okay, we took a couple of examples. Second characteristics is that firms finance investment through bank borrowing. In the real world, banks would use their own funds, and they would also, for the bigger ones, they would be able to issue stocks, they would be able to issue commercial paper, very common in a country like the US, for instance. But for a small or medium-sized firm, typically the only source of financing available is borrowing from a bank, okay? Another characteristic is we have a static framework, and that makes it easier to explain the key mechanism. And of course, you can do more complex models with dynamics, as in the book that I mentioned earlier. After using simple, relatively simple static models, it goes on to develop more complex dynamic models. But the static models, as we do in this class, is essential to get a good sense of what happens to these models when you introduce banks and financial frictions. The assumptions of the model, we pointed out that a key assumption is the Mundell-Fleming production structure, which is the same as in the ISLM-BP model that you saw last semester. There's only one good produced in the economy. It is used for consumption, investment, or export. That good is an imperfect substitute for the foreign good. And domestic agents, households, consume both the domestic good and the foreign good, okay? And in this model, the terms of trade, the price of imports in terms of exports, is the same as the real exchange rate, which is essentially the price of the domestic good in terms of the price of the imported good, okay? And the reason is that, of course, in this model, as I said, the same good is also exported, so the price of exports is also the price of the domestic good. 5 categories of agents: firms, households, banks, the central bank, and the government. Important thing for the central bank, it operates what is called a standing facility. Essentially, it sets the interest rates at which banks can borrow and provides all the liquidity that banks want. So why do banks need liquidity? Well, remember that banks finance their operations mainly through deposits, okay? But they may have to lend more than the resources that they collect. Where do they go? In this model, they would go to the central bank. That's pretty much what happens in the real world, okay? The central bank fixes the interest rate. So when you hear that the Bank of England is raising the bank rate, or the Federal Reserve Board in the US is raising the federal funds rate, or the ECB, European Central Bank, is raising its refinance rate, it's all the same thing. It's the cost at which banks borrow from them. All right? So what banks would do, of course, they would pass on any increase in the cost of borrowing and add to that a premium that reflects, as I said earlier, the riskiness characteristics of the borrowers. So essentially what we are going to assume here to further simplify is that banks are indifferent as to how they finance their lending operations. So whether it's through deposits or through borrowing from the central bank, it doesn't matter, right? In this model, they are essentially identical. So what it means essentially is that no bank is going to pay a deposit rate that is higher than the rate at which it can borrow at the central bank, right? And if a bank tries to offer a lower deposit rate than the refinance rate, competition will make sure that the deposit rate gets increases up to the point where it's equal to the central bank policy rate. Another feature of the model is imperfect capital mobility. It means essentially that the uncovered interest parity condition that we saw in topic 2 is not going to hold. And that's really important because in most of the world, there are restrictions to capital mobility, and therefore it's important to take that into account. The added advantage, of course, is that it allows us to de-link domestic interest rates from foreign interest rates. So if we're trying to explain how central banks affect domestic interest rates, that's an important assumption to make, okay? So I pointed out that you have the technical manual, which goes into great detail in all of this material. We illustrated graphically the functioning of this model, and we started with a fixed exchange rate by looking first at firms, households, commercial banks, central bank and the government will define the cost of living and the real exchange rate, the trade balance, and we stopped, I believe, at market clearing conditions. So for the firms, what is novel here compared to an ISLM model is the fact that we introduce a supply equation, a production function, which is a Cobb-Douglas function. The stock of capital is assumed fixed, given the static nature of the model. It's fixed at K0. So the only variable input here is N, employment. So what firms are going to do, they are going to maximize profits, which is defined by the difference between the value of output, the price of domestic good is PD, times output, minus labor costs, which is the nominal wage, W, times employment. Okay? We also assume that W, the nominal wage, is fixed. When we solve the equations, we maximize profits, we get the first order condition. Once you substitute out for the solution for labor demand into the supply equation, you get this, which essentially says that when prices increase, the real wage falls, and that means that labor is cheaper, firms are going to produce more, okay? And a way to summarize this is just by writing the demand for labor in this form and the supply equation as YS here, okay? In ISLM model, you don't have an aggregate supply equation because output is taken to be demand determined. Prices are fixed, okay? So the demand side determines output. In this model, you have a supply equation, you have a demand side. What is going to bring them into equality is PD, okay? So prices are endogenous in this case. So just to clarify, when I write YS equals YS of PD, it says essentially that the variable YS is a function YS of PD, okay? The alternative would be like you write an equation Y equals F of X. I could define a function that is different, of course, but it simply would make the notation more complicated. So when you see something like this, it says that output, okay, the variable YS is a function of PD. Is that clear? All right, then we define investment being negatively related to the real interest rate. The real loan rate is the difference between the nominal, IL, which is set by banks, and the expected inflation rate, which is pi E, which is not going to play a big role here, but when it comes to explaining what happened to inflation in the past couple of years, we will go back to some, we will have a story to tell about this. But for now, just take it as given. Of course, the derivative is negative. Then for households, we assume that labor supply is inelastic. Now, if labor supply is fixed, essentially, and labor demand is determined by firms, if you had a competitive market, equilibrium between supply and demand would be determined by the wage. Okay? So if there is too much supply, the wage would tend to fall and vice versa. In this case, we also assume that the wage is fixed, right, at W bar, which means that it's very unlikely that supply and demand are equal. Okay? That would be just by chance. In general, there would not be. So there is a possibility of unemployment in this model, but as I pointed out, we're not going to address that because it would make the analysis even more complicated. So there are three types of assets. Households hold domestic currency or cash, which bears no interest. They have deposits with domestic banks, and they have deposits abroad. Okay? So as usual in a portfolio model, if you have three assets and you have a constraint that defines the total value of financial wealth, which is taken as given in the short run, it must be that you can only define two portfolio demand equations for only two of the three variables, because the third one is obviously going to be determined by this constraint here. Okay? In other words, you can reallocate as much as you want your assets within the period between one category to the other. What you cannot do is increase the total value of your assets. All right? So again, that's, if I had a dynamic model, I could easily get rid of this, but that would make the model more complicated. Okay? And again, given that we have three assets, you only need to define two portfolio equations. The first, we define domestic deposits as a share of financial wealth, and we related that to the domestic deposit rate, of course, and the foreign deposit rate. So in standard fashion, when the rate of return on deposits goes up, the demand for deposits is going to go up. If the interest rate or the rate of return on foreign deposit goes up, of course, the demand for domestic deposits is going to fall. These are the two expressions. We define now a second condition for the demand for foreign deposits, and of course, this time, the interest rate effects go in the opposite direction, right? And finally, given that I have those two definitions, I can just use the overall financial constraint to solve for the demand for the third asset, which is M, cash, and that will give me this expression, which once you manipulate it, is going to give me something like this. Okay? And as is typical in a portfolio model where you have a stock constraint, meaning in that case that total financial wealth is fixed, the sum of the derivatives has to be equal to 0. Okay? So that gives you the exact solution. If your stock cannot change, again, you can reallocate when an interest rate changes, but by definition, reallocation toward one asset implies that you're changing the other assets. But the total wealth does not change. Is that clear? That explains the 0 on the right-hand side here. So then we made a comment about those derivatives. I'm not going to go there. And the point is that if you had a closed economy, there's no ambiguity in signs here. But if you have two assets, when the rate of return on one asset changes, well, it allows you, depending on how large that change is, it may allow you to actually increase the demand for another asset, but then you obviously determines what happens to the third asset. Okay? So you can redo those calculations. They're fairly straightforward. Well, in fact, as you will see later on, we don't really use those equations except for when it comes to the flexible exchange rate case. Okay? And you'll understand why later on. We then define the consumption function. So this is one of the key differences with the ISLM. In ISLM, essentially, that C2 coefficient is equal to 0. Okay, so all you have in the ISLM is consumption being related to income, in this particular case to disposable income, which is the supply of output. Remember that GDP is equal to the sum of wages and profits. Well, that's what this says, essentially. This is income. okay, minus taxes. Now the key is that when interest rates go up, whether it's the domestic real interest rate or the foreign real interest rate, when either interest rate goes up, consumption is going to fall. Why? Because if the interest rate goes up, the return to saving increases. So if you decide to postpone consumption, reduce consumption slightly today, you're going to get higher interest income tomorrow, and you're going to be able to consume more tomorrow. Again, the model is not a dynamic model, so I don't capture explicitly what happens tomorrow, but I do capture here what happens today, which is the reduction in consumption. Okay? Now, this is very important. You can already see why, because what is ID? This is the deposit rate. So the deposit rate, as we will see, is just equal to the refinance rate, because borrowing from the central bank and household deposits are assumed to be perfect substitutes, remember? So the two interest rates cannot differ from each other, which means that when the central bank raises the interest rate, ID, the deposit rate, is also going to go up and consumption is going to come down. That's one of the key mechanisms through which central banks try to influence aggregate demand and inflation. If the economy, people are spending too much, okay, in this case it's consumption, the central bank would raise interest rates and bring consumption down. Same thing with investment, which depends on the loan rate. Okay? So that's called the intertemporal substitution effect. And we then moved on to commercial banks, where we define the balance sheet first of commercial banks. You can see on the right-hand side, you have the two components, household deposits, D, and borrowing from the central bank, LB. So these are the resources, okay, or the liabilities, if you want, of commercial banks. And what you see on the right-hand side, this is just the lending, okay? So the lending, as we explained earlier, is related to investment. So lending at any given moment in time is lending at the beginning of the period, the accumulated stock, if you want, plus the flow of lending, which is investment multiplied by the price of the domestic good. This equation here, this is just what is called the no arbitrage condition. Remember from topic 2 when we talk about no arbitrage? It means essentially that if deposits and central bank loans are perfect substitutes, the two interest rates cannot differ from one another. And critical to the functioning of this model is the way the loan rate is determined. The loan rate is determined as a markup over the marginal cost of borrowing from the central bank, which is IR, and theta is a default premium that banks charge above and beyond the marginal cost of borrowing. Okay? So if you are an individual who borrows and has a 0 degree of risk, what would happen? Theta would tend to be low or 0. Okay? So a risky borrower, by contrast, will face a potentially high theta. All right? We are not dealing with the case of perfect credit rationing, because it could be that the risk associated with a particular borrower is so high that the bank may choose not to lend at all. Here, what we're assuming is that the bank is going to lend, but lending will be at a premium. This equation is critical to the functioning of the model, because this is where, as you will see, we get the so-called financial amplification effect. Okay? And how does this effect come through? It's essentially the assumption that theta, the premium, varies inversely, negative partial derivative here, with respect to the net worth of the borrower. The net worth of the borrower is the assets of the borrower. Remember, these are firms, right? What are their assets? The capital stock, K0. And we value that capital stock at the price of investment, which is PD, right? So these are the assets, minus the liabilities, which is the borrowing at the beginning of the period, and scaled by L0 just for convenience. So essentially, what PDK0 minus L0 represent is net worth. So if the net worth improves, the individual will be charged a lower risk premium. Okay? Again, this is typical of the way banks operate. If you go to a bank to get a loan, they're going to ask you for collateral. If you're an individual, they're going to say, you know what, we can accept your house as collateral. They're going to value the house. if market prices go up, the bank will lower its interest rate. Typically, it will lower the premium because you have more value. Countries like in Europe, it's not too common, but in the US, you have so-called home equity lines, okay, that are very common for people. They take when the house prices go up, the home equity line rises as well. So people can borrow more against the value of their assets. It's a good thing and a bad thing because people take money out to go on vacation, to get into the stock market and so on. So it can be a dangerous thing, actually, to take too much equity out of your property, especially if you live in it. But it's a fairly common feature of markets, and that's in the US, and that's also very true of firms when they have assets that are valued also at market prices. So, and then we just pointed out that, of course, if L is determined by investment and deposits are determined by households, borrowing by the central bank is a residual. The central bank, this is the balance sheet of the central bank. The liabilities of the central bank is the cash that it issues, right? And this cash is held by households, okay? On the asset side, this is what you have. You have the lending to the banks, of course, and then the foreign assets that the central bank holds. You should remember this from topic 1, okay? What does the government do? Well, simply, we're not going to talk too much about taxes. We're going to talk more about government spending, so it buys goods. G, we define then the price level, which is the cost of living index. Remember what I said at the beginning? Households spend on domestic and foreign goods. Here the assumption is that they spend a fraction delta of their total expenditure on imported goods, and therefore they spend a fraction 1 minus delta on domestic goods. So a cost of living index is simply a geometric average of the two prices with weights reflecting the share of spending on each category of goods, okay? So this is a common definition of a cost of living index. It's basically based on the distribution of household expenditure, all right? We then define the real exchange rate, Z, which is here E bar, the nominal exchange rate, divided by the domestic price. So if you have a nominal depreciation, meaning that E goes up, it means that Z is going to go up, and that means also depreciation of the real exchange rate for a given value of PD. Next we define the current account, which is this equation, which is the trade balance plus interest payments. Again, we saw that in topic 1. What is the trade balance? It's the difference between exports, X, which is a function of both the real exchange rate and activity in the rest of the world, right? And both with a positive derivative. If the exchange rate depreciates, it means that domestic goods are cheaper on world markets, so exports are going to increase. And if the foreign demand for domestic goods goes up, exports are going to increase as well, okay? So the trade balance is exports minus imports. Remember that households spend a total of C, okay? And a fraction of delta of that C is spent on imported goods. So delta C represent imports. So X minus delta C is exports minus imports. And the Z minus 1 that you see here is simply because the balance of payments is always measured in foreign currency terms. Because X and C are measured in domestic currency prices, we multiply by the inverse of the real exchange rate in order to get the foreign currency value, okay? So once we have that, we can define the balance of payments. Again, remember topic 1. The balance of payments says simply that the sum of the current account plus the capital account has to be equal to the change in official reserves, okay? And what is the capital account? It's minus the change in deposits. So we know that the current account, as we define it, represent an inflow of foreign exchange, right? Because it's the difference between exports, essentially, minus imports. So if you're exporting a lot, you're getting more foreign exchange than you're spending on imports, and therefore CA is going to be positive. For deposits, though, is different. The capital account, the way we define deposits, essentially, if you have an increase in foreign deposit abroad, that's a capital outflow. Okay, so a higher D star means that you have an outflow capital because you're increasing your assets abroad. So we need to put the minus sign here so that we are adding actually inflows. Okay? So that's the idea. So if you're increasing D star, of course, and CA does not change, you have a capital outflow, and therefore reserves will have to fall compared to their original value. Okay? Then once we have all these ingredients of the model, how does the equilibrium happen? Well, you have 6 equilibrium conditions to consider, 5 related to financial markets, and 1 to the goods market. The first one that we considered is the market for loans. Remember that the banks set the interest rate on loans, that's the IL here. They set the interest rate, and they provide all the loans that firms demand to finance their investment. So it's as if you have a supply of loans that is perfectly elastic at IL. And of course, we already saw that the demand for investment is a decreasing function of the loan rate. That's the curve that you see here. So the equilibrium is going to be at the point of intersection of the two. If there is a shift in the demand for loans, there is an increase in investment, for instance. This curve here is going to shift to the right, and therefore the loan rate is not going to change, right, as long as collateral value requirements are not changing and the refinance rate does not change. What's going to happen is that the banks are just going to increase lending. Okay? Very similar story for the deposit market. Banks set the deposit rate equal to the refinance rate, remember, IR, and therefore they are willing to accept all the deposits that households want to make at that rate. Okay? Deposits are determined by household portfolio considerations, okay? And therefore banks will accept whatever households want to deposit at the given deposit rate. So of course, as we saw earlier, the supply of deposits by households to domestic banks is increasing in the interest rate. So if, for instance, there is a shift in that curve, what will happen, banks are simply going to accept all deposits that households want to make, as long as the central bank rate does not change, because ID equals IR. Okay? That's the no arbitrage condition that we mentioned. And the third condition here is the equilibrium condition of the market for loans or borrowing from the central bank. Same story, okay? You have a perfectly elastic supply at the going interest rate, and there is a demand for loans by the central bank. So the derivation is a little bit more involved here, because remember, it's a residual. It's the difference between LB, is the difference between L and deposits. So you have to take the equations for those two in order to determine the demand for LB. And you can see that the demand for LB is downward sloping, of course. If the central bank charges a high interest rates, then banks are going to borrow less, because banks essentially, if the central bank raises the interest rate, they are going to increase the loan rate, right? And therefore that is going to reduce the demand for loans, and therefore how much they need to borrow, all else equal, from the central bank. Again, that's same thing. If there is a shift in the demand by banks and related to a change in the interest rate, what will happen is that the central bank will simply provide all the liquidity that banks want. Okay? So, and I believe that's where we stopped, correct? So that's a pretty lengthy reminder, but I thought it was useful to just go through the whole thing, because once we move on to the flexible exchange rate part, you're going to see that all of these assumptions remain the same. The only thing that's going to happen is that we're not going to be able to ignore the balance of payments. Okay, I'll get to that later on. Now, the next equilibrium condition is the goods market equilibrium condition, which is written in this form. Remember that YS is total supply of the domestic goods, right? If a quantity X is exported, So how much is sold on the domestic market is going to be the difference between the two. Okay? So this is the supply of domestic goods on the domestic market, and we are going to refer to that as domestic sales, essentially. And what do you have on the right-hand side? Well, remember that a fraction delta of total consumption spending by households, C, is spent on imports. So how much is spent on domestic goods is going to be 1 minus delta. Okay? And next, of course, in domestic demand, aggregate demand, you're going to have investment, and then you're going to have government spending, which is G. So 1 minus delta C plus I plus G is what is called domestic absorption. So essentially what you would have in the ISLM model, you would have X would not be there, delta would be 0, right, because you're in a closed economy, and then you would not have YS, you would just have Y here, and you would get Y equals C plus I plus G, because Y is essentially determined by, production is determined by the demand side. Okay? So here we have to explain how prices are determined. But before we do that, I just want to point out that the way the equation was written earlier, you can relate it in a more standard way to what we saw in topic 1 by defining imports explicitly as delta C. In topic 1, remember we define imports as J. Okay, so J is really delta C here. So this is just to remind you of the link with the standard national account definition that we saw in topic 1. So what we want from this market is what? We want the determination of prices. So how is this going to work? Here's the diagram. So it's a bit, you have version actually of the ISLM where they try to introduce this equation, endogenous prices. But here, let me go through the details because this is important. So the first curve that you see here in blue, this is domestic sales, which is essentially YS minus X, okay? Total production of domestic goods minus what is exported. So as you can see here, it's written explicitly as YS is a function of PD, minus X, which is a function of E bar over PD, which is Z, right? And Y star. I've replaced Z here by E bar over PD because we want to show that exports are also a function of PD. Okay? So what you see here is that I've represented on the horizontal axis both domestic sales and absorption, what I call domestic absorption, aggregate demand if you want. Okay? So what this blue line is saying is that YS minus X, domestic sales, is an increasing function of prices. You can see it has a positive slope. Why? Let's look at the two terms separately here, YS and X. What did we show earlier? If PD rises, what happens to output? It increases because the nominal wage being fixed, if prices go up, it means that the real wage is falling, the cost of labor is lower, and that means that you're going to produce more. Okay? But here I'm not talking about YS only, I'm talking about YS minus X. What I'm selling on the domestic market is production minus exports. So what happens to exports here? Do they go up or do they go down when PD increases? Down. Why? When PD increases, what happens to the real exchange rate? The real exchange rate is E bar over PD. What happens to the real exchange rate? Appreciates, correct? If it appreciates, it means that your goods are less competitive on world markets, so your exports are going to fall. So when PD increases, I know now that YS goes up and X falls. So what happens to the difference? It increases unambiguously. Okay? So that explains why the slope of the blue line is positive. When PD goes up, YS minus X is going to increase. Now let's look at what happens to the demand side. The demand side, again, is 1 minus delta times C plus I plus G. So is G a function of PD? Obviously not. G is a policy instrument. It's exogenous. Is I, investment, a direct function of PD? No. And be careful, it's important to distinguish between when I'm looking at one particular market, here this is the goods market, right? I'm only looking at the variables that are directly affecting that market, okay? So I know that investment is a function of IL, but IL may be indirectly a function of PD through the premium, as we will see. But here I'm only looking at the goods market. So I only consider the fact that investment is a function of IL, which from the perspective of this market is taken as given. So clearly, it does not depend on PD. So where is the positive slope that you can see for the red line coming from? Well, remember that consumption is a function of income, of YS, right? So I already know that YS goes up when PD goes up, and that means that consumption is also going to increase. So just based on that, I know that the red line is going to have a positive slope. But as you can see, the red line has a slope that the slope of the red line is flatter than the slope of the blue line. Why is that? Correct. Correct. So when consumption, total consumption goes up, remember that a fraction of consumption, delta, is going into imports. There's also a second effect, which is that you don't spend all of your income. You spend only a fraction, C1, of your income. So when consumption C goes up, spending on domestic goods increases by 1 minus delta times C1 of that increase, which is what you see here. Okay, so the slope then of the red line is going to be flatter than the slope of the blue line. So where is the equilibrium? It is the point of intersection of the two, because this is a point at which supply, or rather domestic sales, remember, because there are always exports in production. So when I say supply, I mean supply to the domestic market, not total supply. Total supply is YS. Supply to the domestic market is YS minus X. You're exporting a part of it. So you can see that there will be a point of intersection for sure, because the red line is flatter than the blue line. So at some point, the two are going to intersect. And when they intersect, what do you have? Aggregate supply equals aggregate demand, and that determines the equilibrium price. Okay? So if aggregate demand goes up, for some reason, whether because I increases exogenously, G increases, as we will see, or because consumption increases exogenously, if there is a shift, an upward shift in aggregate demand, what will happen to prices? The new equilibrium is going to be higher. The economy, domestic sales are going to go up, but prices are going to increase. And when prices increase, we know that the real wage falls, aggregate production is going to increase, and exports are going to fall because the real exchange rate appreciates, domestic goods become more expensive on world markets. You see, have you seen this sort of similar diagram before when you have endogenous prices? You have. Good. Because usually after you're introduced to the ISLM model with fixed prices, then there is some sort of a story about how aggregate supply can be a function of P. The only difference that what we did here, we started from a production function to determine the relationship between prices and output, okay? So this diagram is very similar then to what you've seen before, except that all the underlying reasoning, if you want, is made explicit, okay? And finally, there is the balance of payments equilibrium condition, which is simply that if I move the R star, it's the same equation that you saw earlier. So this is the breakdown of the current account. This is the capital account. So what does this equation determine? And the fixed exchange rate. And the fixed exchange rate, remember, the central bank sets the exchange rate and then provide all the foreign reserves, all the foreign exchange that the market needs. So if you have a capital account surplus, once again, reserves are going to go up. If you have a capital outflow, meaning that this star goes up, you can see the negative sign. Here, R star is going to fall. Okay? Now, as you will see, this equation actually does not play a direct role in the equilibrium. Finally, there is one last equation, which is the equilibrium condition of the market for cash, which will take this form. Remember, M is the supply of cash from the central bank balance sheet, right? And this is simply the demand for cash that we derived earlier, right? It turns out that we don't need this equation because of something called Walras law. Walras law tells you essentially that if you have n markets in an economy, if n minus 1 markets are in equilibrium, the nth market, the last one, will also be in equilibrium. Okay? So if you have, in this case, we have 6 markets. Basically, I can eliminate one of them because I know it's going to hold automatically. So we are simply going to disregard this equation, all right, by referring to Walras law. Okay? So it turns out that it's a very convenient way. Just in case you've never seen what Léon Walras looks like, so that's him right here. Spent most of his career in Switzerland, although he was French. But he spent most of his time teaching in Switzerland. But for our purpose here, it helps us just eliminate the market for cash. And essentially, what we get is when we define the change in the supply of cash here, we realize that it has no effect on the other equations. Why? Because R star is taken from the balance of payments and affects essentially from the balance sheet of the central bank is going to affect the supply of cash. But I just eliminated the market for cash by using Walras law. So by eliminating it, I mean that I don't need to make it explicit. Well, if I don't need to make the market for cash explicit, then R star is not going to appear in the rest of the equations that I just showed you earlier. And that's particularly convenient. It means that R star can take any value that it wants. It will not affect the rest of the model. And this is a characteristic that you call recursiveness. Essentially, the model is recursive, meaning that you can determine the solution for a few variables independently of the others. Here you're going to see that we can determine the equilibrium loan rate, the equilibrium price, domestic price, independently of what happens to R star. So that makes the model particularly easy to manipulate. Now, just to be clear, when I say that we can ignore it, in the real world, of course, if the central bank has to provide reserves continuously because you have capital outflows, like you have a crisis, for instance, and households want to run away from the country, they want to put their money outside. Maybe that rings a bell for some of you, but that happens, unfortunately, on a regular basis. So when that happens, then of course the central bank reserves are going to fall. And if the market observes this fall in reserves, eventually they are going to understand that the central bank is going to come to a point where they are not going to be able to provide more reserves. Okay? So they are not going to be able to defend the fixed exchange rate. At that point, you have a currency crisis. Because once markets understand that the central bank is running out of reserves everybody's going to run to try to get those reserves before the central bank run out of them. Okay? So this, again, is a common phenomenon, less common than it used to be in the 80s and the 90s, especially in developing countries. Currency crises were happening very, very frequently. They are less common now, but they still happen nowadays. If you're interested, you can read about that here. But basically, we've explained all the ingredients of the model. We explained the equilibrium of each market separately, right? We exploited a particular result, Vargas' law, to eliminate the market for cash. And by doing that, we also got rid of the equation of the balance of payments here. So what the next step is to solve now the model and determine macroeconomic equilibrium as opposed to the partial equilibrium graphs that you saw earlier. Okay? So how do we do that? Again, I'm going to give you the intuition for the results. And somebody was asking me last week if you should read about what's going on with the solution for today. And I said, no, don't do that. It's really not worth it. It's best to go through it in class. I give you the reasoning behind it. And once you get the reasoning, it's, I hope, easier to go back and actually read the material and actually try to derive it. And you have your tutorial next week. It's very important that you try to give it a go before the tutorial if you want to get the maximum benefit from the tutorial, especially if you don't remember how to do total differentiation, for instance. If you don't, you should be looking at that before the tutorial. Otherwise, you're going to waste your time. So let me then explain how the macro equilibrium works. Well, let's wait 5 minutes.
So that's what the slope is. It's not just monetary, but it's also.
Yeah, well, this is the last definition. But again, you can do so you don't really need Okay, so let's continue. Just to be clear, when I talk about X, when X changes, exports change, it's because it changes in response to the exchange rate, to the real exchange rate, Z, which is defined as E bar over PD. So Z and PD move in opposite direction. So if prices go up, PD goes up, it means that Z is going down. Again, you have to refrain from using, when we talk about exchange rate, remember I told you let's refrain from saying it's going up or going down, because it depends on how you define it. So when I say Z goes down, it means that Z appreciates. Okay, if there is an appreciation, the price of your goods on world markets is less competitive, which means that therefore you're going to export less. So if you have YS minus X, you're trying to understand the blue line, for instance. The blue line tells you that if you have prices going up, then output is going to go up because the real wage is going down, and the real wage is going down because the nominal wage is fixed and prices are going up. The real wage is the ratio of W bar over PD, right? W bar is fixed, PD goes up, the real wage is going to fall, which means that output is going to increase and exports are going to fall because of the appreciation, okay? So let's now get to the real story, which is the macroeconomic equilibrium. Again, I'm going to give you a sense of the intuition behind the results, and I'll explain the derivation, but very briefly, without getting into the details, all right? So the first equation that we want to focus on is the loan rate. Remember that the loan rate is IL, and it's equal to IR plus theta, and theta, if you recall, was defined in that particular way. I just divided by L0. So if I want to write IL in functional form, meaning without having to write all the details here, I'm just going to write it as a functional form, FF, with the arguments that are endogenous. In this case, it's going to be PD. And anything that you see after the semicolon represent exogenous variables. So what is the endogenous variable here? It's going to be PD. And IR is, of course, the refinance rate, which is controlled by the central bank and is exogenous from the perspective of banks. So what is when you have a functional form like this with several variables, then you can define the partial derivatives of each of this functional form with respect to each variable. So in this case, the derivative of FF with respect to PD is going to be simply this expression here. You take the derivative of theta, and then you take the derivative of what's inside, right? This is the derivative of a function, all right? So it's going to be theta prime multiplied by the derivative of this term here, which is taking K0 divided by L0 as constant. So this is what you get. And of course, it's negative because theta prime is negative. And the derivative with respect to IR is quite simple. It's only the coefficient of IR, which is 1, which is what you see here. Okay? So the advantage of doing that is you're going to see that when it comes to solving for the impact of shocks, it's much easier to work with this than to use those expressions. This is not too difficult, actually, for FF. We could still use this. That's not very complicated. But when it comes to the second equilibrium conditions, you're going to see that the expression are a bit more messy. So therefore, it's easier to define the functional forms like this. So what is this telling you? Essentially, when prices go up, the loan rate is going to fall. Why? Because when prices go up, the value of collateral increases, and banks are going to charge a lower premium. As we will see, this defines the financial amplification effect that is commonly referred to also as the financial accelerator or the balance sheet channel. This is really at the heart of modern macro, basically, okay? Those effects through the financial system. An important thing to note here is that ID does not appear in the equation, but that should be clear from what we do, what we discussed earlier. The second equilibrium condition is the equilibrium condition of the goods market. Now, the derivation of that equation is a little bit more involved because both on the left-hand side and on the right-hand side, I have equations that need to be plugged into it in order to solve the equation. Okay, remember that equation says ys equals 1 minus delta c plus I plus g. Well, I have an equation for ys, the supply of goods, right? It's a function of PD. And I have an equation for C as well. And I have an equation for investment as well. So I have to plug in those expressions and manipulate them so that I can get a relationship between two core variables, which is the loan rate and the price of domestic goods, just like I have an equation for between those, a relationship between those two variables from the financial side. Okay? So how do we do that? Well, again, you're going to go through the details in the tutorials. You can give it a go if you want. Once I make all those the substitutions, this is what I'm getting. You can recognize here the supply equation. You can see what is inside the curly brackets here. This is the consumption function. In addition, you can see that I have replaced ID by IR because of the relationship between the two. And I've just eliminated, because it's not really useful here, I've just eliminated pi E, right? The expected inflation rate, we don't solve really with respect to that. And you can see that in the investment equation, I have IL, okay? The loan rate. And in the export equation, what I replace Z by E bar over PD. I have to make all those substitutions because at the end of the day, what I want is a second relationship between the loan rate and PD. So if I want to get that relationship, I have to substitute for consumption, for investment, for exports, and for output. Okay? So once I have this expression, what do I do with it? Well, what you do is you take a total differentiation of the equation. Again, you will have to go through, if you don't remember how to do that, look at the mathematical appendix. Essentially, I assume that all the variables that appear in the equation are going to be changing. That's the first step. I write the complete, I differentiate totally the equation, and then I regroup terms, essentially. And one of the terms that I'm going to have to regroup at first, it's going to be the terms in PD, because you can see that PD appears here on the left-hand side. That's the supply effect. PD appears also in the consumption function, right? That's the income effect, but also PD is going to appear in the export equation. So when I do the differentiation, I have several terms in PD that I need to regroup in order to get to the solution that I need. For IL, it's less complicated because IL appears only once here. Okay? So the total differentiation is going to give me the expression that you see here. So essentially what I did is I kept investment here, and I moved everything on the other side. And that gives you, as I mentioned, this term in PD. The term in G is very easy to derive. X is very easy. The term in PD is complicated in a way because exports are a function of the real exchange rate, and the real exchange rate is the ratio of E bar over PD. So when you're taking the derivative of X with respect to PD, again, you have to take the derivative of a function of a function. All right? So that's what makes this term a bit more complicated. So once you go through this, essentially, you can show that, but now I have isolated IL here on the left. I have a term in PD, and then I have all those terms in IR, I star, Y star, and G, which are all exogenous variables. I can write the relationship between IL and PD as this functional form, GG, right? Which, again, is going to isolate PD as the other endogenous variable. And after the semicolon, these are all exogenous variables. G is going to be government spending, which we're going to use to study fiscal policy. IR is the policy interest rate or the refinance rate, which we're going to use to study monetary policy. And Y star is activity in the rest of the world, which we're going to use to study an external shock. And I star is the foreign interest rate, which we're also going to use to study the impact of a foreign shock. So to summarize, from the financial side of the model, I derived a first equation between the loan rate and the domestic price. That equation is very easy to derive because it is based directly on the equation for IL. Okay? So that one does not give you any problem in a way. Where things get a bit more complicated is when you solve for the goods market equilibrium, because essentially you have the price, which is the key variable here, of course, that is affecting both the supply and the demand side, both through consumption, and you also have exports that matter, that also depend on prices. But once you do differentiate totally this expression, you regroup terms, and you can write this equation also as a functional relationship between the loan rate and PD. So your tutorial next week is going to be focusing on this derivation. Okay? So again, I encourage you to try to do it beforehand. You have the results only shown here. The technical manual has the derivation step by step. So do look at it so that you can see. But let me just comment on the signs here. Because once you do the derivations, let's just, don't forget the expressions themselves. Just look at the signs. What it says here is that the partial derivative with respect to PD is negative. The partial derivative with respect to government spending is positive. The partial derivative with respect to the refinance rate is negative. And the partial derivative with respect to foreign output is positive, whereas the partial derivative with respect to the foreign interest rate is actually exactly the same, takes exactly the same form as the partial derivative with respect to IR, and is also negative. So what's the explanation here? Let's take the first one, which is this one, which appears complicated here, as you can see, but the sign is unambiguous. We know that this is going to be negative. Why is that? Let's suppose that, when you interpret a partial derivative, remember, the easiest way to think about it is when there is a small increase in one variable, you keep every other variable constant. Okay, that's the definition of a partial derivative. All the other variables are kept constant, endogenous or exogenous, doesn't matter. You only look at the effect of that particular variable. So what I'm looking at now is what happens when there is an increase in PD. Well, you're going to have several effects. First, as we already indicated when we looked at the partial equilibrium of the goods market, when you have an increase in PD, aggregate supply is going to increase, right? Because again, the nominal wage is fixed. The real wage is the nominal wage divided by PD. So if the nominal wage is fixed, PD rises, the real wage is going to fall, the labor is cheaper, you're going to produce more. So YS PD, which is the partial derivative of production with respect to PD, is positive. Okay? So that would be this term here in this expression. Okay? The second effect, we already again alluded to that earlier when we looked at the slope of the aggregate demand curve in partial equilibrium. When there is an increase in PD, income rises, and therefore consumption is going to rise. But we know that consumption is not going to rise by YSPD, like aggregate supply, because a fraction of any increase in income is spent on imports. You only spend 1 minus delta on domestic goods. And in any case, you don't spend all your income anyway. You only spend a fraction C1. But we know that this is going to increase as well. That's the second effect. There's a third effect, which is that when you have lower, you also have lower exports, right? As we mentioned, if Z, which is E bar over PD, when PD goes up, Z, which is E bar over PD, is going to fall, meaning that it's going to appreciate. You see, I'm catching myself also talking about a fall here, but I did say appreciation here. Okay, so it appreciates. Okay, there is indeed a fall in Z, and that's measured by this term here that you can see. Z over PD is the equivalent of E bar over PD squared, right? Because Z is E bar over PD. So and when I write Z over PD, you can write it for yourself if you want. This is also E bar over PD squared. When you take the derivative of a function of this form, then the derivative of 1 over u is minus u prime over u squared. Remember? Okay, so that's what you're getting here. So A means that you have aggregate supply increasing by YSPD. B means that aggregate demand increases by a fraction of that. So what is the difference between the two? We're going to call the difference the net supply effect. Okay? So what is the sign of the net supply effect? It's definitely going to be positive, because supply is going to increase by more than demand. So that's positive. What happens to exports? Well, we know exports are going to fall, right? Because the real exchange rate appreciates. So if I'm looking then at the goods market, right? I'm looking at, I know that exports are falling, supply is increasing, so net supply is increasing. And I know that on demand side, consumption is going to fall, right? Or rather, it's going to not going to fall. It's going to increase, but by less than the increase in supply. So the net supply effect is indeed positive. So what happens then? Clearly, you're going to have excess supply on the domestic market, because supply increases by more than demand. So when you have excess supply on the market, what happens to prices? What should happen to prices? Yeah, but I'm already considering a change in price here. I'm already talking about an increase in prices, right? So if I stay focused on an increase in prices, right, what should happen then? If prices are going up and I know that there is excess supply. Well, if there is excess supply, there must be, what should happen? Well, you need to reduce excess supply. What should have happened to aggregate demand? If you have excess supply, it means that supply exceeds demand. So here's supply, here's demand. Demand is below. What should happen to demand? It has to go up to go back to that equilibrium. So what is going to bring this mechanism, this equilibrium now, or this increase in demand? It can only be investment here. So for investment to increase, what do you need? What should happen to the loan rate? No. You need aggregate demand to, okay, you agree with the excess supply part, right? So aggregate demand has to increase. What is the mechanism that is going to bring this equilibrium? It can only be an increase in investment. So for investment to increase, what should happen to the loan rate? It has to fall. And that indeed then explains the sign of this derivative. Okay? So you see, even though the expression looks a bit messy, and it's the only one, in fact, the others are easier, But even though you have several terms in that expression, and we can explain them all, there is no ambiguity in the sign. When you have an increase in prices, domestic production increases by more than aggregate demand, so the net supply effect is positive. And exports also fall, which means that domestic sales are higher than demand. You need demand to increase. The only way for demand to increase is for investment to increase, and for investment to increase, the loan rate has to fall. Okay? Let's consider an increase in G now. When you have an increase in government spending, what happens? Now you have the opposite case. You have excess demand. Remember, again, this is a partial derivative. So I'm not going to consider what happens to any other variables, including prices. Okay? I'm only looking at what happens to G and what are the implications for the equilibrium, if you want, through the loan rate. So when government spending increases, there is excess demand now at initial prices or holding prices fixed. There is excess demand. So what do you need for what do you need to restore equilibrium? Can supply change? Be careful. I'm only looking at an increase in G. Does an increase in G affect supply directly? No. The only thing that affects supply directly is because the wage, meaning the price, exactly. Whether it's YS or X, the only thing that affects domestic sales is PD. And this is a partial derivative, so I keep PD constant. So if I keep PD constant, nothing can happen on the supply side. So if I'm here, this is supply and demand. I like to use my hands to do this, but so if I have supply here and demand here, aggregate demand goes up because government spending is increasing. So if supply cannot change, what do you need? You need to bring aggregate demand down. So how do you bring aggregate demand down? Through investment. It means that investment has to decrease. So how does the investment decrease? The loan rate has to go up, which is exactly what you see here. Okay? So, and I think that's what is important. When you work through this model, it's extremely useful to just go through the economics beyond the math. The math has to be consistent with what your intuition is telling you about the relationship between aggregate demand and aggregate supply. Every time you look at a variable, specifically, ask yourself what happens to the supply side. Any other change than PD, you have to keep the supply constant. So if the demand goes up, something has to bring the demand down. If demand goes down, something has to bring it up. Okay? So the only difference is that when it comes to exports, exports depend not only on PD, but also on foreign output. Okay? So we'll get to that later. Next, the increase in interest rates. Whether it's IR or I star, it doesn't make any difference. Same question. Is IR change in IR or I star affecting the supply side, domestic sales, YS minus X? Yes or no? No, because those changes in interest rate don't affect that. What happens when interest rates go up? Whether it's the refinance rate or equivalently the deposit rate, right? Or the foreign interest rate. There is the intertemporal substitution effect. Households have greater incentives to save. So what happens to consumption today? Consumption is lower. So here's again, aggregate supply, aggregate demand. Demand falls. So what do we need? We need to bring demand back to where it was, to restore equilibrium. So we need to increase demand. How do we increase demand? The interest rate has to fall in order to stimulate investment. Hence the sign here, the partial derivatives are negative. Okay? And the last one is basically the increase in Y star. Here, I emphasized that PD is the only variable that affects both components of domestic sales, but Y star also affects exports. The domestic sales are going to be affected when you change Y star. So let's see what happens again. So supply and demand. So Y star goes up. What happens to exports? You're going to export more. Therefore, domestic sales are going to fall. Correct? Is that correct? So if supply falls, does Y star affect aggregate demand directly? No. So you have to find a way of bringing aggregate demand down as well to restore equilibrium. So how do you bring aggregate demand down? Investment has to fall. So, and for investment to fall, you need the loan rate to go up. Okay? Hence the sign of this derivative. Is that clear? You see how this works? Always then go back when you are looking at, just remember, because that's a source of confusion, when you're looking at partial derivatives, remember, always keep everything else constant. Ask yourself what happens to aggregate supply, what happens to aggregate demand, and how do you restore equilibrium?
What is Y star?
Foreign output. That was defined when we defined exports. Export is a function of Z and Y star. So now basically I have two equations, FF, right, which relates IL and PD, and GG, which relates IL and PD. Both of them, there's a range of additional variables after the semicolon, which are all exogenous, which we're going to study later on. But essentially, what we have, I can combine, since I have two equations in two unknown, I can just study the equilibrium graphically, which is the nice thing about it. I have two endogenous variables, IL and PD, and two curves, and so what I'm going to do, and both of them are negative, so this is macro equilibrium essentially. Because GGPD is negative, then the red curve, which we call GD, so this is the equilibrium of the goods market, okay? So this is going to be downward sloping. FF is negative as well, therefore it is also downward sloping. Now the question, of course, when you have two curves that are downward sloping, which one is steeper, right? And this is very important, obviously, to determine the properties of the model. Here, I'm going to ask you to just take it from me that GG actually is steeper than FF, okay? I cannot prove this to you here. We can't even do it in the tutorial because it relies on a mathematical result that I don't want to get into, all right? It's actually in the appendix of the technical manual, okay? But I don't want to go into it. It requires using what is called Samuelson's correspondence principle, and it's a way of linking a dynamics with a static model. But this is way too complicated for us, so just take it for granted that GG is steeper than FF. You'll never be asked to prove that, okay? Just accept that GG is steeper than F. For those of you who are more mathematically inclined, you want to look at how you can prove this, it's in the appendix of the technical manual, but this is not required, all right? To be clear. So you can see the equilibrium. It's simply the point of intersection of these two curves, right, which is at point E, and that gives me the equilibrium price and the equilibrium loan rate. So all we're going to do is to take this diagram, right, and look at how the curves are going to shift in response to different shocks, whether they are macro policies, fiscal and monetary policies, or external shocks. That's the whole exercise, essentially. And later on, we're going to be using this diagram also to understand how to fight high inflation. Just to point out that there's a more complicated way, if you want, of presenting this diagram. I'm not sure it's more complicated, but more informative, I should say, rather. So it's the same, the upper part here, the northeast, has the same relationship between PD and IL as the one we just saw, okay? But then we can use the other quadrants here to represent other variables. For instance, here, in the northwest quadrant, you can see that this is the negative relationship between investment and the loan rate, okay? So this is the function I as related to IL, okay? If IL goes up, you can see that investment falls. So when you use these 4 quadrant diagrams, you have to be careful when you interpret them. Sometimes you may want to turn your head to see exactly what they look like if you were using a straight diagram. But this is quite convenient because when you look at shocks, it gives you all the effects in one go if you want. So this is the investment function. And here you can see this is the relationship between prices and domestic sales, which is YS minus X. And you can see that this relationship is increasing. Again, visually, when you look at it, it looks like it's decreasing, but you have to reverse the axis in order to understand that this is actually increasing. Okay? Consistent with what we said. As prices go up, supply increases. And of course, if I use finally on this side, okay, if I use this diagram on the southwest, you can see that, and I use a 45-degree line to report the level of investment, which is here, and the level of output, which is here. Basically, the difference between the two is going to give me consumption of domestic goods plus government spending. Because what is this here? The difference is also domestic sales minus investment. If you take the goods market equilibrium condition, you move investment on the left-hand side, you're going to be left with 1 minus delta C plus G. Okay? So that's the most that you can do. You don't really need to use this, probably not even while reviewing the material. I put those diagrams because, again, it shows you in one go what happens to a number of variables in the model. Just a minor point, you can see, for instance, that this equation, it is shown as a linear equation. Here as well, it is shown as a linear equation. That's not necessary. In fact, for output, for aggregate supply, we derive the equation explicitly, and you can show that if alpha is less than 1.5, this curve would be concave, basically. It would be like this, basically. Okay? But it doesn't really make any difference to the results, and therefore we show it as a linear curve for simplicity. You can also derive the equation for R star, but now you can see very clearly what I was saying, that the model is recursive. You can see that R star does not appear in the FF equation, and R star does not appear in the IL equation. So for all practical purposes, we can ignore R star, subject to the caveat that I mentioned earlier, if you have large losses in reserves due to capital outflows. So now we're ready to use this. I just showed you on these slides what are the equations needed to solve the equilibrium curves, FF and GG. This is in the PowerPoint, it's in the manual, and it's in the handout for the tutorial. All right, just review this. Please do so before you go to the tutorials so that you can take the most benefit from your sessions. So we're ready now to use the model to study policies. And once you understand how to do it for one variable, then the rest is just exactly the same procedure. All right? So follow with me here what we do. When you have a model like that where you have two functional forms, right? Remember we have FF, which relates IL and PD, and after the semicolon in FF we have IR, right? After, in the GG equation, after PD we have more. We have G, IR, Y star, I star. I can study the properties of the model when any of these exogenous variable changes. A change in G is fiscal policy, a change in IR is monetary policy, and a change in Y star or I star would be an external shock. Okay? So what's the procedure if you want? When you have two equations like that written in general functional form, what you do, essentially you differentiate again those equations with respect to the endogenous variables and with respect to the particular variable that you are looking at. So if I'm focusing on G, what I'm going to do is I take the FF equation, and it's going to be essentially a differentiator that gives me DIL. It's going to be FFPD times DPD, right? Plus the differentiate with respect to G, but remember, G does not appear in the FF equation. So what is the coefficient of dg in FF when I differentiate FF? It's going to be 0. Okay? And when I do the same for the GG equation, I'm going to get DIL, and that's going to give me the derivative with respect to PD times dPD, plus the derivative with respect to G, which I know is not 0, of course. This time it's GG. So then, once you have those two equations, it's as if you have a system of two equations, two linear equations in two unknowns, variables, okay? So the simplest way to solve it is to use Cramer's rule, where you essentially put this in a matrix and you solve this using standard results for the solution, okay? So what I'm doing, as you can see, I'm isolating these two variables, the endogenous variable, and I multiply them by the coefficients that appear here. So to show this very clearly, you move those two terms here in PD, move them to the left. So you're going to get the coefficient of DIL is 1. The coefficient of dPD, once I move it to the left, is going to be minus FFPD. Is that clear? Yeah? Same thing, and I'll leave, of course, the DG on the right-hand side. Same thing for the second one. I move the dPD term on the left. The coefficient then is going to be 1 for DIL, and the coefficient is going to be, for dPD, is going to be minus GGPD. Okay? So the expression that you see on the left-hand side is exactly the same for every shock. The only thing that is going to change is what is on the right-hand side, because that depends on the variable of interest. Okay? So you don't even have to bother to write this every time if you want. If you know the partial derivatives, this expression does not change. You just take the variable that you're interested in and write the partial derivatives in a column. All right? So once you get that, you use Cramer's rule. Cramer's rule, and again, I can't go through it here. You're just going to take the matrix in which you replace this column in the first one to get DIL, and you divide by the determinant of this expression. So what is the determinant here? Obviously, it's going to be the cross term here, which is going to be minus GGPD, minus the other cross term, which is going to be therefore plus FFPD. Okay? So that's the expression. You divide then the matrix with this column in here for IL. You put in this column here in the second to get PD, and you divide every time by the determinant of this matrix. All right? Again, once you understand the rule, you apply it systematically. It's the same every time. And given that the left-hand side is not changing, the determinant obviously is not going to change. You're always going to be dividing by the same term, which is FFPD minus GGPD here. So that's what you see here, right, in both cases, and that's always going to be the case. You see the signs above, just to make clear what it is. Remember that what we assume is that GGPD is steeper, the curve GG is steeper than FFPD, and that means that the derivative with respect to PD of GG is larger than FFPD. So what is the sign of this expression here? This is minus, and you have a minus here. And GG is steeper than FF. It means that this term here, GDPD, is greater in absolute terms than FFPD, right? Given there's a minus sign here, what do you get? This term is going to be positive, exactly. Again, every expression that you're going to see for shock is always going to have this in the denominator, okay? So after replacing the column, you can see very clearly that the solution gives you a negative sign here and a positive sign. What does that mean? Economically, if G goes up, the loan rate is going to fall. If G goes up, prices are going to go up. So government spending is inflationary, actually. Okay? If you spend too much, if the government spends too much, that's going to raise prices. We're going to see that's one of the problems that some countries have faced in recent years. So let me just show you the graph to study this. And this is going to convey the intuition very, very clearly, I hope. So basically, remember that the initial equilibrium is point E. This is the point of intersection of FF and GG. All right? So what happens when the government when the government increases spending? We already know that the derivative of GG with respect to G is positive, and FF does not depend on G. What will happen? Then we know that it's only the GG curve that's going to shift. Okay? How does it shift? We know that when you have an increase in government spending, aggregate demand is going to increase. Okay? So at the initial level of prices, curve GG is going to shift up. Okay? Again, this is just the fact that the partial derivative is positive. Partial derivative means that PD is given. If PD is given, it means that you're going vertically to see what's happening. Right? So if the derivative is positive, holding prices constant, you know that you're going to go up, necessarily. Okay? So at holding prices constant, what happens? There is a new point, of course, on GG. Is that an equilibrium point? It cannot be, because an equilibrium point is a point at which both FF and GG intersect. Correct? That would be a point like E prime. So how do you go from E to E prime? Well, let's see what happens first, again, holding prices constant. Holding prices constant, I have an increase, again, and we've already done that reasoning, I have an increase in spending. So aggregate supply is given because prices are given. Aggregate demand goes up. What do we need to happen? We need aggregate demand to fall back. How is aggregate demand falling back? Investment has to fall. How does investment falls? The loan rate, again, has to go up. So as you can see in the graph, holding prices constant, meaning I'm going vertically above point E. I'm not going to the left or to the right because prices are constant. Indeed, GG is going to shift up. I've already established that, but I'm going to shift at this point here, which is called B prime, is the increase in the loan rate that allows you the goods market to go back in equilibrium. I know it's an equilibrium for the goods market because it's located along GG, of course, right? But is it a macroeconomic equilibrium? No, because at B prime here is not a point of intersection. Moreover, who sets the loan rate in this economy? The loan rate. Commercial banks. So what is B prime? B prime is how much the loan rate should change to restore equilibrium in the goods market. But banks set the loan rate on the base as a markup over the cost of refinancing. Banks are not going to set the loan rate to restore the equilibrium here. So basically, when the increase is to B prime is just purely hypothetical. It cannot happen because there's nothing that induces banks to actually change the loan rate when you are at point E, even after a change in government spending. So what happens then? The excess demand that is created cannot be eliminated by a change in the loan rate because there's no way. Because there's no way for banks to increase in interest rates just to equilibrate the goods market. That's not what they do. Okay? So what happens at point E? The loan rate does not actually change. There's no change in the loan rate. Banks would not change the loan rate. So the jump to B prime is purely hypothetical. This is what you would want to restore equilibrium in the goods market, but banks are not going to increase loan rate to that extent. They actually don't increase the loan rate at all because you are still at a position where IR is constant and prices are given. Remember, we're looking at what happens when you're moving vertically above point E. So what happens then? Well, supply does not change and you have excess demand. So how do you eliminate the excess demand? Supply has to increase. And how does supply increase? Through prices. So prices, so starting here, you're going to be moving to the right. The excess demand, now you can see when I look at the macro equilibrium, what is restoring equilibrium between demand and supply is actually the increase in prices. So the economy is going to move along the FF curve. And this is something that you need to keep in mind when you're looking at this. Whenever you look at a graph for the fixed exchange rate, you are always, any movement has to be along the FF curve. Any movement. So that's why you can see that what happens here is only hypothetical, because what determines the loan rate is the equilibrium condition for firms, the markup condition for the loan rate, and so you're always going to be along the blue line here. So indeed, at point E, nothing happens to the loan rate, but as prices go up to eliminate excess demand, the loan rate is going to fall along the blue line. Why is that? Why is the loan rate falling as prices increase along between E and E prime, the new equilibrium? Exactly, exactly. As prices go up, the value of assets, remember, is PD times K0. The value of assets goes up. So what do banks do? They have more collateral value in case you default. Banks are going to charge a lower premium. Therefore, the loan rate is going to fall, as you can see, between E and E prime as prices increase. So fiscal policy is expansionary because the increase in prices lowers the real wage and increases output, but it is also inflationary. Okay? Prices do go up as a result of an expansionary fiscal policy. Okay? So that's the key story here. This graph just shows you what happens in the 4-quadrant diagrams. I'm not going to go through it now because I just want you to absorb what happens when we deal with the 2-quadrant diagrams. But eventually, you may want to see exactly what happens here. You can see that if the loan rate is going to fall, clearly investment is going to be higher. If prices go up, output is going to be higher, and so on. All right? So the bottom line is that when prices increase, you're going to have 4 effects. And every shock, and when it comes to PD, you're going to have 4 effects. You have the aggregate supply effect, meaning that YS is going to go up because the real wage falls. You have an aggregate demand effect because as income increases, consumption increases as well. But remember what I said earlier, the net supply effect is going to be positive because aggregate demand, consumption goes up by less than the increase in income. Consumption goes up by 1 minus delta times C1. Okay? So the net effect from those two is still going to be an increase in supply of domestic sales. There is also an appreciation. As prices go up, again, Z is going to fall. That means exports fall, meaning that that's going to add also to domestic sales and to the excess supply of goods, right? And what you're going to get here, there's also another effect. As PD goes up, the premium falls, you're going to have an increase in aggregate demand. During the transition, there is an increase in prices again, and that increase in prices translates into a lower premium and therefore an increase in investment. And we can see that because income increases, consumption increases, there's no crowding out. I'm going to skip the change in T and just finish with monetary policy. So what happens now if you increase the interest rate? Well, you have the exact same thing is happening. First, we differentiate totally FF and GG, again, if you want, with respect to this time IR, right? I move the term in PD to the left. That gives me the same matrix as you saw earlier, right? I apply Kramer's rule in the same way. And then what I get this time is that when IR increases, the loan rate is going to increase. The derivative is positive. I don't get into the derivations, okay? This you'll work out in the tutorials. And here you can see that prices are going to go up. In other words, an increase in interest rates means that monetary policy is contractionary, right? Prices are going to go down, output is going to fall, and therefore monetary policy works by raising market interest rates and by inducing a drop in consumption. So this time, both curves are going to change. When there is an increase in the refinance rate, the first thing that is going to happen is that the FF curve is going to shift up because the increase in IR, the refinance rate, is passed on to borrowers fully. So FF is going to shift up. So the actual loan rate is going to jump from E to B. But what happens when the refinance rate goes up? The deposit rate increases, which means that consumption is going to fall. So if the loan rate were to adjust to restore equilibrium in the goods market, the loan rate would have to fall to stimulate investment. So we know that GG is going to shift down, but the reduction in the loan rate that you see from E to B prime is purely hypothetical. It doesn't happen. Because banks are actually going to increase interest rates from E to B in order to reflect the more expensive cost of borrowing from the central bank. Okay? So FF shifts up, GG shifts down. You can see that the new equilibrium is going to be at E prime. And what happens during the process, because you have a higher loan rate, investment falls. And because there's also a higher deposit rate, consumption is also falling, so aggregate demand is going to fall. So you have a situation of excess supply this time. So when you have excess supply, prices are going to, what happens to prices? They're going to fall. And indeed, the new equilibrium is at E prime here, the new point of intersection. You can see that prices fall continuously, right? And as prices fall, the value of collateral increases. When the value of collateral increases, you can see that the loan rate is going to continue to increase. Actually, did I say price increase? Prices fall, which means that the collateral falls, sorry. Therefore, the premium is going to increase. So the initial jump from E to B reflects the increase in the cost of borrowing from the central bank. IR increases. But what happens between B and E prime is the subsequent increase in the loan rate due to the fact that collateral values are lower and the premium increases. So the movement from E to B is the mechanical effect of monetary policy. And the movement from B to E prime is indeed what is called the financial amplification effect. Because collateral values fall, banks are going to charge a higher premium to borrowers, and that premium means that the loan rate is going to continue to increase until there is a new equilibrium at E prime. Okay? So please have a look at all this before you go to the tutorial, and hopefully they will go through the mechanics with you. I'll see you next week. Sure. We have to go out because I'm waiting for